Alright guys, welcome to this Forex trading course. We are at lesson 1. So if you are new here, this is the first lesson of the whole entire series. And also I'll be doing a couple of investing lessons. I don't know why lesson 1. Okay, lesson 1 is here. And after that, I'm going to do a couple more lessons. How to invest in commodities for beginners, how to invest in bonds, oil, gold, silver, important market indicators. This is just a draft. If you're a complete beginner, you don't know anything about investing, then these are the things that I'm doing for you. So if you want to support me, you can subscribe to this channel so you don't miss out on these lessons that I work really hard. I put in tons of weeks to craft all these lessons. Back to this Forex course because this is why you're here. What I'm going to teach you today is I'm going to teach you some intro on what Forex trading is all about, because if you're a beginner, you have no idea, right? So I'm gonna teach you that, and then I'm gonna teach you the tools you need to trade Forex, and then the basic terms you need to know. What are lingos that traders use that make them sound so sophisticated, how to read currency codes, how to get involved in the Forex markets, how to make money, and also how to profit from it. And also I'm going to teach you today the types of currency pairs, how to pick a currency pair, factors that drive the Forex markets, trading sessions, types of traders, order types, types of analysis, and also brokers. And if you don't know who I am, I'm a Singapore speaker. If you want to follow those get rich quick people, feel free to follow them. But if you're still here and if you want to go through this course, then make sure you take out your notebook, pen and paper to write down all the notes, and also take your time to read this disclaimer. So let's get into that. Basically, what is Forex trading? In short, it is called FX, or some people call it currency trading. Some people call it the scam market, whatever. When you're trading Forex, what you're doing is that you are buying a currency and then selling another currency at the same time. So if you are in stock investing, you can buy a stock. But if you are buying a currency pair, let's say for example euro dollar, when you are buying euro, you have to sell dollar, okay? So you cannot avoid selling when you are a currency trader. And it is the largest financial market in the world. As of now, about $5+ trillion turnover per day. Alright, per day, you hear that? Basically, what you're doing is you're trading money when you're trading Forex, and there's no central marketplace. It's an OTC market. A lot of people say, oh, this is an OTC market. What does it mean? It means that it is an over-the-counter market, meaning prices are set by interbank market. This means that there's no physical exchange that you can go to. For example, if you go to New York, there's a physical place where you can go to trade. For example, futures, ETFs, options. But for Forex, everything is done online. There's no physical place to go to. Okay, this is what they mean by OTC markets. And the product is quoted by banks. That's why when you are with different brokers, you realize that, hey, my euro dollar is at a different price as compared to another broker, because different brokers also quote you different price. But don't worry too much about the price difference, because chances are it's not going to vary too much, like 100 pips, 200 pips. That's just crazy, okay? And it fluctuates based on which currency is stronger at the moment. So this is very important because this concept will allow you to determine which one to buy, which currency pair to sell. There are also various trading centers, the more active ones being UK, US, alright, and also Japan, Singapore, Switzerland. And with trading being more concentrated on specifically London and New York, this is really important because later on in the trading sessions, you are going to know when to trade and when not to trade. And a lot of people ask, okay, what's this interbank market? Basically, it is a place where trading takes place in between brokers and dealers, and also liquidity providers. Okay, so this is what I mean by interbank markets. So as a forex trader, what you are part of is a big investment community or trading community, because there are so many things that you can trade and invest in, right? And forex is just one of it. So what I always tell people is that if you have mastered forex trading, make sure you also learn other things. For example, if you like stocks, then you can go and learn stock investing or stock trading, because as you know, multimillionaires, they have multiple sources of income, so you cannot just rely on forex alone. But when you're learning it, make sure you learn it one by one. Don't go and learn forex today and then tomorrow you go and learn stocks, then tomorrow you go and learn ETFs, then tomorrow you go and learn options. Then you'll be all over the place. Then it's going to be like super confusing. Understand what I'm saying? So what are the benefits of trading forex? It is a 24/5 market. Why is it not 24/7? Because in the weekends you can't trade. Alright. And the good thing about 24/5 market is that you will see less price gaps, because if you're a stock trader, you realize that there are a lot of price gapping, okay? Overnight gapping, whatever you want to call it. The price closed here today, then the next opening session, the price opened right at the bottom. Then sometimes when you set your stop loss right here in between, you wouldn't get stopped out. So that is the dangers of a market that is not 24/5, okay? And the good thing about forex is that there is not a lot of price gaps except for the weekends, okay? Because when Friday closes, Monday opens, if during the weekends there's a major news event that is happening, it's going to cause a price gap. But most of the time, the gap is not going to be that wide, okay? And it is a highly liquid market, as I said, 5.1 trillion. More than any other markets combined. If you combine the stock market, futures markets, options market, the trading volume, combine everything, it is still less than forex markets. So the good thing is that this makes the forex markets highly liquid, and hence the higher the liquidity, the higher the predictability. Now if I talk about this term predictability, this doesn't mean that you can predict the markets, because nobody can, including me. If you can predict the market, just like those people who promise you 100% win rates, please tell these people to go become a fortune teller, because you can earn more money that way. And the third benefit is you only have to focus on a few popular pairs, because if you're a stock investor, how many stocks are there out there? So many, right? But then currency traders, they only need to focus on 20 pairs. In fact, 20 pairs is too much. As a beginner, you can trade with 1 pair, 2 pairs. It is enough for you, okay? And the next benefit is the quick speed of execution. Now these brokers, they are competing with each other. You know, I'm gonna be faster than you, alright? Oh, you think you're fast? My friend, I'm gonna be faster than us traders. We have the benefit of getting our orders filled really quickly. If you have a broker that takes maybe 3 seconds to fill your order, like it's just loading, like PlayStation 1, then it's like you gotta leave, my friend. Then the fifth benefit is leverage. Now this thing about leverage, in the forex industry, a lot of people market to you, oh, you can trade with high leverage of 1:100. Freaking crazy. You don't need such high leverage to make good money. If you have high leverage, you're going to kill your account really fast. As a beginner, try to use a leverage of less than 1:50. In fact, 1:50 is a bit too much. To be safe, 1:20 and below. Yes, it magnifies your profits to allow you to get rich quick. Like how some trading channels promise you, which is what you want to hear. Well, go and listen to them, okay? You're gonna get poor quick. I'm sorry, you're gonna get rich quick. If you're a stock investor and you come to Forex, you'll be like, oh my god, there's no commissions. So good. So how brokers earn money is that they would earn money through your spread. Okay, I'll talk about this spread later on. Not your butter spread, okay? And the thing is, it enhances the overall returns of your portfolio, because as compared to bonds and certificates of deposits, Forex can give you a higher return. You need a low starting capital due to leverage. Now, this is a marketing tactic that a lot of people use. You can start with low capital, then over leverage, then you can earn a lot of money. Now, the thing is, this is the problem with the Forex industry. Retail trader thinking. Stupid. If you believe in this kind of marketing schemes, which I believe a lot of people do, that's why people will promise get rich quick, grow a lot faster, which is unfortunate because I have a lot of friends who are real practitioners. They are on YouTube and they don't grow as fast as those random jokers who promise you can start with $100, you can become rich. Doesn't make any sense. And the good thing about high liquidity is that there's no room for insider trading effects. Now, insider trading is illegal, so try not to engage in that because it got a lot of good people into trouble in the past many years. And the good thing about Forex is that it makes you money regardless of economic conditions. This means that during a recession, you can make money because you can short sell certain currencies. You can also buy certain currencies that is going to do well during recessions. For example, during the recent COVID-19, Forex traders didn't get affected a lot because they are still making money regardless of whether the markets are going down or is it going up. Okay, so that's the good thing about being a Forex trader. With anything, there are bad sides of it. First thing is a lot of people use it to gamble. Like if you're rolling in money, my friend, and you just want to play, gamble Forex, you got so much money, you don't know what to do with it, feel free to do that. But my problem is way too many people, they don't have a lot of money, but they use this as a game. You want to play games. Recently, Last of Us 2 came out, like GTA 5 was free a few months ago. Play all you want. Just don't play around with Forex. And like I said, high leverage can become a double-edged sword. Start with small capital, trade with high leverage, earn tons of money, and you are set for life. If it is that easy, everybody would do it. And also, if your heart cannot take it, just bear in mind that in Forex, there is high volatility, especially if you trade the not so popular currencies, which later on okay, which are the ones. And then also 90% of traders lose money. And some more, it is stressful for those who don't know how to handle it, especially if you're a beginner. So it's very important for you to learn how to manage your trading psychology. That's really important. Okay. So basically, who is involved in the Forex markets? Now, it's very important for you to understand who are the participants because you need to understand who controls the markets, who can so-called manipulate the market prices. So the majority of the participants are financial institutions. The majority of the volume are contributed by financial institutions. Okay. So you have brokers and dealers who are involved in making transactions for clients, and you are the retail trader if you're watching this, which comprise a small percentage as compared to the institutions like banks, hedge funds, and also companies. And MNCs, corporations, companies, they don't really trade per se, but most of them use it as a hedging instrument. Basically, they trade into futures, okay, currency futures. Because let's say, for example, if you have a US company, their suppliers are from China, okay, then they need to pay their suppliers in yuan, right? It's very weird if they pay their suppliers in US dollar, right, when they are in China. So they wouldn't want the dollar to weaken against the yuan, so they need to hedge against it. Of course, there are some companies who use Forex as a speculating instrument, but most of them, I would say, especially MNC companies, they use it to hedge. And also commercial banks, which provides the trading volume, which of course help increase the liquidity. And also you have your physical money changers. So in a way, most people have so-called traded in Forex before, especially if you go to other countries, you gotta change to another currency, right? What a lot of people do in Singapore is that they would change their SGD to Malaysian ringgit because Malaysia is just beside. By the way, Singapore is not part of China, that's why Malaysia is beside. And of course, you have hedge funds and investment management firms who are involved in it. Some of them use currencies to hedge, some of them trade, some of them invest in it. And also pension funds, as well as government and central banks. So if you are a retail trader, particularly what you need to pay attention to, what the central banks are doing. Okay, are they printing more money? Are they injecting more money into the economy, or are they withdrawing money from the economy? That's really important. And also brokers and dealers. Okay, these are the two main ones you need to focus on. And the tools you need to trade Forex, of course, common sense, computer and internet connection. And of course, I know some people trade with their phone. So the first thing you need to have is to have a good trading platform. And if you're a beginner, you can start with MT4. I feel that it is very user friendly as compared to something like Bloomberg, which took me like 3 weeks to learn. Maybe it's because I'm just slow. Karen, what kind of computer model do you recommend? There's no specific model, but as long as you buy something that can install games, that can support a game. By game, I don't mean like Solitaire, Minesweeper. Game, I mean something like GTA, SimCity, because I'm not good at computers, but you need the sophisticated tech to be able to run the trading platform properly. Understand what I'm saying? And also you need a reliable broker. There are people who also ask me, Karen, is it possible to trade without a broker? I wish, man. So make sure you pick the right broker. That's really important. And optional things, office, because you're gonna get into the mode of working. Okay, right now I'm working, right now I'm sleeping, right now I'm trading. This is why a lot of traders that I know, they have a trading desk. Alright, so this is optional as well. If you don't want an office, you just set up a trading desk. This table is just for trading. I'm not gonna eat here. You get the point, okay? Knowledge and experience. Make sure you learn from the right kind of people. Personally, I've invested 50,000 to learn trading investing. Some of my friends invested 100k to learn trading investing. And then there are jokers who invested nothing to learn trading investing. They just learn from random articles. Then they think they can teach trading. And if you don't like me, don't learn from me. So some basic terms, lingo you should know. Why is it so important for you to understand lingo? Because if you go to a trader's meetup, then people ask you, for example, so did you see the head and shoulder pattern yesterday in the charts? Then you're like, I'm so sorry. I didn't know you're a fan of the shampoo. First thing you need to know is liquidity. Like I said, it's the volume, the amount of interest in the markets, alright? Basically, how many participants there are making orders, making transactions. What is a bull market? Bull market means that the market is going up, okay? To put it simply, upward trending market. This means you should go long. What does it mean by going long? It means you should buy. Bear market, this means that markets are going down. This means that you should short. Short meaning you should sell, okay? Pip is the smallest unit of measurement of a currency pair. Pip actually stands for percentage in points. To put it simply, when you're playing games, you score points, right? So when you're trading and you harvest profits, you are scoring pips. So if you're a gamer, you treat this like a game? No, wait. I mean, okay, let's just move on. Leverage allows you to use a small sum of capital to control a large sum of money. What is a margin? It is the amount of money available in your account or used to open a trade. There are a couple of margin terms: free margin, available margin, use margin, margin call. More on that in the future or maybe later. What is us? Basically, it is the price in which you buy the currency. Alright. Bid is the price in which you sell the base currency. Alright, take note of this, is the base currency. And the spread is basically what your broker earns. It's the difference between bid and ask price. Correlation, what does it mean by correlation? It means that it is the extent to which one currency moves in the same or opposite direction to another currency. If I say that these two assets are positively correlated, it means that both move in the same direction. If I say that these two asset classes are negatively correlated, this means that they both move in the opposite direction. Base currency is the currency on the left side. Quote currency is the currency on the right side. So for example, if today you are buying one standard lot, later on you understand what does it mean by one standard lot, okay? If you're buying one standard lot of dollar, yen today, let me write this properly, dollar, yen, what you're doing is essentially you're buying one standard lot of the base currency, which is dollar, using yen, which is the quote currency. You're buying 100,000 units of dollar, US dollar, using yen. Okay? So I'm going to talk a little bit more about leverage margin because a lot of people ignore this. So you need to understand that, okay, margin is equal to 1 divided by leverage. Ignore my handwriting because I'm a left-hander and my freaking mouse is right hand. Margin is equal to 1 divided by leverage. As you already know, when you're trading with leverage, you are essentially trading with borrowed money, okay? So this means that if you're using a leverage of 1:1, you need a margin of 100%, alright? If you're using a leverage of 1:10, 1 divided by 10 times 100, which gives you 10% margin requirement. If you are using a leverage of 1:20, then your margin requirement would be 1 divided by 20 times 100, which gives you 5% margin requirement, so on and so forth. So let's say if you are a beginner trader and you start with a $100 account and you decide to use a small leverage, a good leverage of 1:20, okay? This means that your maximum usable margin value would be 20 times 100. You can control $2,000 worth of currency, okay, without having to put in $2,000. So if you want me to go into detail and make a video about leverage and margin and a different margin, margin call, margin, available margin, let me know down in the comment section below because I take your feedback very seriously, okay? Very seriously. Okay, how to read a currency in stocks if you trade stocks or invest in stocks. The symbol, ticker symbol for Apple, it is denoted as AAPL. Some of them 3 letters, some of them 2 letters. For example, Facebook is denoted as FB, Coca-Cola is KO, and then Microsoft is MSFT, is 4 letters. You get the point. But when it comes to currencies, it is denoted in 3 letters all the time. Okay? And the first 2 letters actually represent a country. So in this case, the country is Japan. So for USD, the first 2 letters is US. It stands for United States, of course. The third letter is the currency, meaning yen. Y stands for yen. Then the third letter for USD is D, which stands for dollar. So the most traded currency pair as of now is USD. Might change in the future, who knows. But based on 2019 data, the most traded currency is dollar. And the most traded currency pair is euro dollar, okay? Now different forex brokers offer different types of currency pairs and also different amounts of currency pairs. So when you pick a broker, you also need to take into account, does your broker offer the currency pair that you're looking at? If not, then pick another one. So as a forex trader, it's very important for you to understand each of the currencies inside out. Alright, so dollar, there's a nickname for it. It is called the greenback. Some people call it bucks, and it's the most significant and liquid currency. So some people see it as a safe haven currency, but after the financial crisis, the dollar's safe haven status is not as good as compared to pre-2008. But overall, because most investors, they still perceive dollar as something that's safer as compared to other countries, sometimes you see that when times are bad, investors would still flock to US treasuries, US securities, and it's used as a monetary reserve for central banks. So it is one of the major reserve currencies. And a move in dollar will affect other markets and currencies. Because majority of the transactions are done in USD, even for business transactions, it's also mostly done in USD. So you can say that the movement of USD would affect the other markets, most other markets. In fact, a lot of the emerging market currencies, they are pegged against the US dollar. And you need to understand that the US policymakers, they prefer a stronger dollar, they favor a stronger dollar. Now, when it comes to this term called pegging, okay, there are different types of it. If you want me to do a video on this in detail, also let me know down in the comment section below. Because when it comes to which currencies are being pegged against USD, it would determine which kind of currency you should trade and you should focus on, okay? And the next currency that is also very popular is Euro. This is the currency used by Eurozone members. Now, there are many reasons why Euro is getting more and more popular. Political reasons, economic reasons. A lot of traders nowadays, they use this as an alternative to USD, okay? Right, an alternative to USD. And it makes up about 57.6% of the dollar index. Some people use the euro to gauge the movement of dollar. Euro dollar in particular, okay? Euro dollar, and which is an actively traded pair. The next currency I want to talk to you about is Japanese yen, JPY, and it is a very popular safe haven currency. This means that when times are bad, you will see the yen going up, and it fluctuates based on economic state of Japan and its trading partners. In fact, you realize that economic data from Japan, the Japanese economic data, it doesn't move the yen that much. The movement of yen is more influenced by the trading partners, which is, for example, United States and also China, okay? And it is a popular currency for carry trading due to the low interest rates. So that's why some people will call the yen a low yield currency, okay? A low yield currency. If you have watched my previous videos, you would know which are the high yield currencies, which are the low yield currencies. Very important to know which are the low yield, high yields, so that you know during a recession which currencies is going to go up, which currency is going to go south. Now the next currency is Swiss franc, in short CHF. And also it is a popular safe haven currency. Sometimes you see Swiss franc going up more than Japanese yen and also dollar, because the Swiss economy is so small. So when they receive a massive influx of capital inflow, it would exert a higher pressure on the Swiss franc, okay? And Switzerland is one of the most stable economies in the world. That's why it gives traders and investors a lot of confidence during bad times. And also Switzerland, they are known for low unemployment and also very low inflation rates. And Switzerland is also a major exporter of some very important commodities. For example, jewelry. You know, the Swiss watch that a lot of rich people like. You know what I'm talking about. And if you look at how the Swiss National Bank manage the economy, you realize that they have a conservative monetary policy. And over the past few crises, you realize that they try to avoid printing money. About central banks, more on this later on, okay? Movement is mostly based on external factors. So the next currency is British pound, GBP, and is also known as the pound sterling, nickname cable. And London is one of the key trading centers, so you need to take note of that. And it's one of the most widely held reserve currencies. And it's very important for you to take note of the pound because the country is one of the largest economies in the world, a major importer and also exporter as well, so you gotta take note of that. So it is one of the major reserve currencies behind euro and also behind dollar. Okay, then the next one is Australian dollar, AUD. Some people call it Aussie. It's a commodity currency. Some people call it high yield currencies. One of the major exports of Australia is gold, so sometimes you see some positive correlation between gold prices and also Aussie dollar, depending on the situation and also circumstances, and also risk sentiment. So it's also a very popular currency for carry traders. One of the major trading partners of Australia is China. And because the Chinese economy is not transparent, in fact, a lot of the internet stuff is not transparent. They have their own social media. So because investors don't really have access to the Chinese markets, hence a lot of investors, they would use Aussie dollar as a proxy, okay, as a proxy for the Chinese yuan. Alright, because the economy is closely tied to China. So one thing you need to take note of is that when times are good, a lot of times you see Aussie dollar going up, because one of the reasons being the high interest rates, which is what a lot of carry traders like. They pair a high interest rate currency with a low interest rate currency. And the next currency I want to talk to you about is CAD, Canadian dollar, also known as loonie. There's a story behind it, which I'm not going to elaborate. So the economy is closely tied to US. In fact, US absorbs most of its exports. And one of the things that Canada export, which they're known for, is oil. And I'm going to talk more about oil investing in another free course, which I'll launch onto YouTube. So stay tuned for that. So Canada is a major oil exporter. So if you're an oil investor, you gotta take note of that. And also if you trade Canadian dollar, you can use oil prices as a reference. Okay, next currency, New Zealand dollar, NZD, known as Kiwi. Okay, and the economy is closely tied to Australia. And the currency is also influenced by almost the same factors as Australia. For example, GDP growth, inflation rates, interest rates. And also New Zealand, they rely highly on commodities to drive their economic growth. And one of the major exports of New Zealand is agricultural products, milk, dairy products. But recently, because New Zealand, due to the not so good balance of trade levels and also high debt levels, that's why you see traders losing interest on New Zealand dollar and also losing confidence on it. But overall, I would say it is still considered a high yield currency. Of course, it might change in the future. Nobody knows. Alright, so if you go to your platform, you realize that there are a couple of magic numbers. So what do these magic numbers mean? So let's say if today you are trading your dollar and the price right now you see on your platform is at 1.09571. This means that at this point in time, 1 euro is equal to 1.09 USD, right? This means that it's going to take you 1.09 USD to buy 1 euro. Understand what I'm saying? When you go to your terminal, you're going to see this thing called bid and ask. Just now I did taught you what does it mean. So when you decide to buy euro dollar today, you would be buying at 1.09585. Okay, so if you decide to make a sell trade on euro dollar today because you feel that it's going to go down, you will be selling at this price, 1.09574. So what is it that you are buying at a high price and then selling at a low price. Doesn't make sense, right? Because this is how your broker earns their money from you. So the spread is actually this one. You see this number 11, this is actually 1.1 pips. Okay, divide by 10, 1.1 pips. So one thing you need to take note of when it comes to calculating pips is that euro dollar, you need to measure it in terms of 4 decimal places. Okay, and over here you see 1, 2, 3, 4, but you have the 5th number. Why is that? Because some brokers, they just want to be more detailed. But when you count your pips, you need to count in terms of 4 decimal places. So if you look at the different currency pairs, euro dollar quoted in 4 decimal places, and any currency with yen inside it, you count it based on 2 decimal places. Again, you ignore the last number. So for example, if you take dollar yen, 107.673 minus 107.657 would give you 16, right? But because it's counted in 2 decimal places, then it is 1.6 pips. So for euro dollar, you are paying how many units? 4 decimal places, 0.0001 units. So let's say if you are trading 1 standard lot today, and because 1 standard lot is equal to 100,000 units, then how much spread do you need to pay? 100,000 times 0.00011, you need to pay $11, okay, just for the broker. So this is why brokers, they want you to trade with large lot size, so that they are going to pocket more money. Okay, now if you're confused about units and all that, here's a guide for you. Like I said, 1 standard lot is equal to 100,000 units, 1 mini lot is equal to 10,000 units, 1 micro lot 1,000, 1 nano lot $100 units. So if you're opening a trade today and you put in a volume of 0.3, what does this mean? It means that you're buying how many units? 30,000 units worth of currencies. Now there are some brokers who require you to key in units, in terms of units. Some platforms, they require you to key in the volume, so you need to check properly, okay? So make sure you double check. Are you supposed to key in units, or are you supposed to key in volume? So if you key in a volume of 1, basically you are trading 1 standard lot, which is 100,000 units. And one very important thing when it comes to the sequence of your trade execution, set your stop loss, take profit. Do this 2 things first, okay? Then the next step, calculate your lot size properly, okay? Not just anyhow. Today I wanna trade 0.1, let me trade 0.1. I'm feeling good today, let me trade 1 standard lot. Doesn't make sense. Once you have determined all these things, determine what type of order you wanna execute, pending order or market order. Later, more on that. Do all these things. Do all the things on the top first. Of course, make sure you pick the right currency pair. Don't trade the wrong one. Do all the things on top first. On top first. Then you focus on clicking either buy or sell. Most retail traders, they don't really care about the stuff on top. You know what? I just want to make a trade right now. I want to make money. I'm not here to calculate mathematics. So some of the ways you can get involved in the Forex markets. You can trade the spot markets, okay? If you want to trade the currency now, you don't want to wait for the future to come, then you should trade in the spot market, okay? You can also get into currency futures and forwards, just like how most of the companies, they use it to hedge. And you can also trade currency options. Beginners, please don't dabble into options. It is high risk, high volatility. There are so many cases of people, you know, losing big time in options, so be careful with that. You can also get involved using FX swaps. If you want me to make a detailed video on this, let me know. Spread betting. And also physical exchange, like I said, the currency exchange. Now physical exchange, I don't mean a trading floor, I mean money changes, okay? Money changes. So when you go to airport, you see money changes. And some people will say, Karen, how come I cannot just trade with the money changes? First thing first, if you don't mind traveling to airport or your money changer all the time, then go ahead and do that. Second thing is, the spread on those money changes, 5 to 10%. Airports are a lot higher, and the spreads are not that favorable as compared to retail forex brokers. So why would you want to do that unless you're traveling, right? And you realize one thing, okay? Currencies with relatively strong currencies, they attract people to go there to work. But countries with relatively weak currencies attract people to go shopping. Aha! So now you know where to go shopping. Just look at the countries in which their currencies are very weak. Plan your next trip now. Okay, not now, because now it's COVID-19. You can also get involved using currency ETFs, exchange traded funds. I'll do a more detailed free course on this. Free? Wait, free? Should I charge for it? ETFs, they are listed on the exchange, so it's easier to buy and sell. But mutual funds, you need to go through a manager, and there are fees involved, management fees, which is not going to produce very, very good returns. One thing that's quite similar to ETFs is ETNs, exchange traded notes. But why is it not so popular is because if you're an ETN investor, you need to assume the credit risk of the issuer. So ETFs doesn't have that, so which is why investors, they prefer ETFs. Okay, so how can you profit from the forex markets? If you're a stock investor, you can earn money through dividends and also when the stock price goes up, okay? Meaning capital appreciation. Same thing with forex. Capital appreciation, you buy, currency goes up, you make money, you sell, currency goes down, you make money, okay? And also another less talk about way of making money is interest income, meaning swap. So this is where carry traders come in. Okay, there's this thing called carry trading, which is quite popular in Japan, especially among housewives. Okay, they do this thing called carry trading because, you know, yen has low interest rates, and then they buy a currency with high interest rates that gives high interest rates. The difference between that, you have your interest rate differential, which gives you some earnings. So in stock investing, it is like getting dividends. And if you invest in real estate, you buy the property, the prices go up, you make money. And then your rental income, regular rental income, is your interest income. I've done a video on carry trading, so if you're interested, you can go and watch it. Capital appreciation. So if you trade based on this, you are trading based on strength and weakness. So you want to buy a currency which is strong at this moment and pair it with a weakening or weak currency. So if the base currency, which is the left side currency, is stronger than the quote currency, which is the right side currency, then you can make a buy trade in anticipation of the currency going up. If the quote currency, meaning the right side currency, is stronger than the base currency, meaning the left side currency, then you should make a sell trade in anticipation that the currency is going to go down. If you look at a currency like euro dollar, the euro is your base currency and then your dollar is your quote currency. Now how do you earn interest income? So let's say, for example, if today Eurozone interest rate is at 4% and US interest rate is at 1%, you take 4% minus 1% would give you your interest earned, which is 3%. So you have your interest rate at 4%, dollar interest rate at 1%. If you buy euro dollar, you would earn an annualized interest rate of 3%. But if you sell euro dollar, you will be charged instead of getting paid. So if you sell and you want to make money from interest income, from swap, then you need to make sure that the right side currency has a higher interest rate than the left side currency so that you make money. Understand what I'm saying? But you know, when it comes to interest income, it's not that significant for a lot of Forex traders, because first thing first, most Forex traders, they trade really short term. And second thing is, your capital appreciation is going to help you cover your losses in swap. So one thing for sure is that interest income is only significant for people who trade long term. So if you are a day trader, short term trader, don't need to care too much about this. So basically, how do you calculate your profits? This is really important. Of course, the platform is going to calculate for you. But before you get into the trade, you need to have an idea. If this trade works out, how much money am I going to make? In summary, the formula is like this, okay? Number of pips harvested. Pips, okay? Times value per pip times number of lots. Let's say today you're trading euro dollar. The value per pip is $10 per pip, okay? And you're trading one standard lot. So you have your value per pip, you have your lot size, then your number of pips harvested. Let's say if you entered at this level, okay, this is your entry level at 1.08458, and you set your TP at 1.08920. This is your TP. 1.08920 minus 1.08458 without taking into account of the spread. Your number of pips harvested is 46.2. So in overall, your total earnings is $462 if this trade works out. This is without taking into account of the spread, so if you minus off the spread, then it's slightly less than this, okay? So as a currency trader, you gotta know your types. Just like how when you pick a husband and wife, you gotta pick your types, if I'm making sense. Now, currencies can be classified based on many ways, but I'm just gonna talk about two ways right now. If you classify it based on liquidity, then you have major pairs, minor pairs, and then exotic pairs. If you classify it based on yield, you have high yield currencies and also low yield currencies. So I've done some videos where I talk about high yield and low yield, so if you want to check it out, you can check it out. For now, I'm just gonna talk about these three, okay? As a beginner, focus on this first. The major pairs, let's talk about this. For example, euro dollar. I know you're sick of hearing of it, but it is what it is. So it's most popular among traders for some reason, and it includes US dollar and currencies from developed economies. This is what all the major pairs are all about. They are some of the most liquid pairs in the forex markets with low spread. Now the good thing about having high liquidity is that it will tend to have low spread, so you pay less to the broker. Make yourself rich instead of making a broker rich. And it is relatively more predictable. Now, again, nobody can predict the markets except those fortune tellers. And it is relatively less volatile as compared to the not so popular pairs. As a beginner, you can start with major pairs, alright? So these are some of the major pairs that you can pick from. And don't start with all the pairs on day one, because just like when you pick a boyfriend and girlfriend, you cannot like date 10 people and then after that you pick one to marry. It's like, and minor pairs, example, you have your euro pound. Minor pairs don't have the US dollar in it, so if you are loyal to USD, then you avoid minor pairs, and it's suitable for more experienced traders. But personally, I feel that beginners, you can also start with this, and it's more volatile and less liquid, and hence higher spread than the major pairs. But occasionally you will realize that, okay, Euro Swiss franc and Euro yen would offer low spreads, just as low as the major pairs. So these are some of the minor pairs, and again you realize that there's no USD inside. Okay, pick whichever that pair is suitable for your trading strategy, because some strategies only work for certain currency pairs. Some of them work for euro pound, some of them work for pound yen, some of them work for everything. And the next one is exotic pairs. Example, USD, SGD. SGD is Singapore dollar. Now I look at all these exotic pairs only when I go to the money changer. Like for example, if I wanna change Singapore dollar to Malaysian ringgit, then I'll look at the rates. Otherwise, I wouldn't even look at the charts to trade. Okay. So exotic pairs are also known as emerging market currencies, and it consists of USD paired with a currency from a smaller country, and most of them emerging markets. This liquid and less predictable, and hence higher spread, and it's not as popular among traders. But if you're a long-term trader, you can look into this. So these are some of the exotic pairs. HKD stands for Hong Kong dollar, SEK stands for Swedish krona, ZAR, South African rand, DKK, Danish krone, and then NOK, Norwegian krone. Now, even if you have the ability to trade exotic pairs, there is no point because of this thing called floating and fixed regimes. And this is another way to classify currency pairs, which not a lot of traders, retail traders, talk about, because this is what most professional traders focus on. You gotta know these two things. The first thing is floating exchange rate regime. Basically, they are currencies in which their prices are not fixed and are allowed to float freely in accordance to market movers. Basically, it's allowed to float freely according to market forces. Okay, for example, dollar, euro, pound, yen. And there is another type of regime called fixed regime, in which the currency prices, they are pegged to the value of another currency. For example, Chinese yuan, it is pegged to USD. The good thing about fixed regimes is that it provides stability to a currency, but it wouldn't be volatile enough for traders to trade, and hence there's no point trading it because the currencies doesn't really move much. For example, SGD and Hong Kong dollar. Now SGD, Singapore dollar, it is weighted against a basket of many different currencies. They don't want people to speculate on SGD. And even though Chinese yuan is pegged to USD, it doesn't mean that the price doesn't move at all. It is pegged at a crawling rate, which means that it is not fixed at a certain rate. Okay, if you want me to do a detailed video on this, let me know. And the downside of having a fixed regime is that it is quite expensive for countries to maintain a fixed regime, as compared to if the currency is adopting a floating rate regime. So the thing is, how should you pick the right currency pairs? Based on different types of criteria. First one is, how often does the currency pair trend or range? Because if you're a trend trader, you want to pick a currency pair that trends more, right? So how often the currency pair ranges depends on the interest rate differential. If you want to know more, you can watch my video on range trading. I've already done something like that. And also, how liquid or volatile is this pair? The thing is, a lot of people like to ask, Karen, what currency pair should I trade? It depends on a lot of factors, right? Like the volatility. If you have a high risk appetite, if your heart can take it, then you trade the volatile pairs. And also, you want to trade the liquid pairs, the more liquid pairs, so that the spread is lower, and also so that it is so-called more predictable. You need to also know what kind of news would be more significant for this currency pair. What is the best time currency pair? You gotta know this too. What is so unique about this currency pair? How will the movement of this pair affect the other pairs that I trade? This means that you need to understand the correlation. Remember when I said correlation? If you are trading many different pairs, you gotta understand this. Alright? And also, how would this pair behave in a risk on or risk off environment? I won't go into detail on these two things, maybe for future videos, because this is a basic video course. Which central bank has the most impact onto this pair? You also need to know. If you're trading dollar yen, it's very important for you to understand the monetary and economic policies of United States and also Japan. So some key points to take note. Like I said, only pick and learn one currency pair first when you're starting out. Once you have mastered that pair, whatever it is, euro dollar, then you move on to the next pair. For example, if you like dollar yen, then you pick dollar yen. Don't trade too many currencies even when you have become experienced. I learned this the hard way. I thought that the more currency pairs I trade, the more profitable I become. It's not about the amount of currency pairs that you should trade. It is about the quality of the currency pairs that you pick. Pick currency pairs that are highly liquid and predictable. And understand that different pairs have different behavior and volatility. And different pairs also require different trading strategies and also targets. By targets I mean TP targets and also stop loss because of the difference in the volatility. Understand what I'm saying? So you cannot be like one size fit all. Okay, 20 pips for all the currency pairs I trade. Doesn't make sense. Okay, so some key factors that drive the Forex markets. There are many forces, for example, economic data, NFP, interest rate, inflation. There are lots of economic data, but one thing you need to take note of is that don't go and look at the lagging economic indicators and then try to predict where the currency pairs is going to go. Because way too many retail traders, they use NFP to trade. Doesn't make sense, because what professional traders do is that they look at the leading indicators to tell them what the NFP data is going to be in the next 6 months, 3 months. You know what I'm saying? So by the time you go into NFP as an amateur retail trader, you are trading against the professional traders. So you need to understand that even when it comes to economic indicators, there are leading economic indicators, there are lagging economic indicators. If you want me to make a detailed video on this, let me know too. So many retail traders lose big time because they are looking at lagging economic indicators. That's what a lot of people don't tell you. And if you go and listen to those random jokers on YouTube with no financial background, it's like the blind leading the blind. You can keep on watching those people. Next thing, political events, elections, which is this year, so take note of that. Commodity prices will also drive Forex markets. Central banks, technical levels, societal and ad hoc events. Stock market will also have an impact. Natural disasters and foreign affairs. And also pandemic. But basically all this comes down to supply and demand. Okay? Because all these events is going to affect how traders and investors perceive the data and hence would affect the supply and demand. Understand what I'm saying? I can go into detail and talk all day about each of these. Commodity prices, central banks, technical levels, stock market. Each of these can be a whole lecture, which let me just move on. One fundamental concept you need to understand is, of course, when a country's economy improves, this is going to cause the country's currency to go up. If you dig deeper, what would cause a country's economy to go up? First thing first, consumer confidence have to increase first. And when consumers are spending more money, businesses earn more money. And when businesses earn more money, they are going to produce more. And when they can earn more money, they can produce more, they will sell more stuff. When they sell more stuff, they'll earn more money. When they earn more money, they are going to have more money to hire people. So they are going to hire people and provide more jobs to the economy. And when people have more jobs, they are going to spend more. More businesses are going to benefit. And hence, you see stock market going up, country's economy improving, the currency will go up. Okay? Now this thing about trading sessions, you need to understand this because there are certain times of the day where it is better and safer to trade. Very important, especially if you're a day trader, but if you're a long-term trader, I don't think it really matters. But if day trading is still what you want, you gotta take note of these few trading sessions. Now I'm based in Singapore, so I'm using Singapore time, okay? Sydney market is from 5 a.m. to 2 p.m. Singapore time. Tokyo market is from 7 a.m. to 4 p.m. Singapore time. Again, this chart is also based on Singapore time. London from 3 p.m. to 12 a.m. Singapore time. And New York from 8 p.m. to 5 a.m. Singapore time. So I realized that certain of these sessions, they overlap, okay? You can see over here. Europe, Asia overlap, and also US, London overlap. So whichever trading center is open at that point of time, the brokers are going to pull the quotes from that trading center that is currently open and then give you the quote. So best trading time, it actually depends on the currency pair that you are trading. Because for example, if you are trading Aussie yen, then it's better for you to trade during this time. For most currency pairs, the best trading sessions are during the overlapping. Okay, overlapping of the various trading sessions. In particular, the US London overlap. Alright, but of course you can trade the Europe Asia overlap as well if time permits. But this doesn't mean that if you're trading Aussie yen, you cannot trade once these two trading centers are closed. It's just that when you trade, let's say Aussie yen during the London New York session, the spread would be more. Understand what I'm saying? It's not that you cannot trade euro dollar during the morning in Singapore. It just means that the spread would be slightly higher as compared to if you have to trade during, let's say, afternoon time when the London market opens. Right? Now, because a lot of people like to ask me, Karen, what is the best time to trade? Again, it depends on a lot of factors. That is why you need to learn how to ask good questions. Okay, and another question that I get a lot from people is, Karen, what time frame is the best? That is like asking a CEO of a company, oh my god, you earn so much money, what business do you start? Of course, it's important to know, to get an idea, but then if you're asking that question just to copy that person, it's not going to work out. Because different traders, they have different trading personalities. They have different risk appetites. So if you're somebody with high risk appetite, then you should become a scalper. If you're somebody with conservative personality, you should become a position trader. You're not introvert, you're not extrovert, you're somewhere in between. Then you're what people call an ambivert, is that correct? Oh. Same thing for trading. When you're somewhere in between, you can become a day trader or swing trader. So what is this scalper, day trader, swing trader, and position trader? Basically, a scalper is somebody who holds their trades for a few seconds to a few minutes. A lot of retail traders, and also those jokers who don't know what they are talking about online, they preach, you are a beginner, you should scalp, because you know what, exciting, fast money. And hence a lot of retail traders, they also get into scalping. And then they're like, Karen, trading is so stressful. I wonder why. You're watching a chart and look at every tick. Every tick, the price moves, your heart skips a beat. I wonder why it is so stressful for you. But of course, with that said, there are good scalpers, but these are experienced people. Okay? And basically, scalpers, they trade the 1 minute time frame, 5 minute time frame, 15 minute and also 30 minute time frame. And this requires a lot of screen time and precision. So if you're a good gamer, you have your mouse skills, then you should become a scalper. The reason why I don't encourage scalping to a lot of retail traders, beginner retail traders, is because first thing first, chances are you're making a broker rich every single time you open a trade. Like you make 50 to 100 trades a day. Seems like you're being productive, right? But you're taking like 5 pip, 2 pip, 3 pip, and you're paying the spread to who? And it gives you high stress levels. If you look at the interviews I have with my friends who are bank traders, they always tell me this one thing, Karen, if you scalp, it's very detrimental to your physical, mental health. I don't know about mental health, but physical health. So basically, these type of traders, they make the most amount of trades per day. Yup, you're so productive, harvesting 2 pip, 3 pip every single trade. Now don't get me wrong, I've been a scalper, and what I find is that I'm putting in a lot of screen time. I experience all this stress, then it's not worth it. Okay, until I move to higher time frames, then I become more profitable. Unfortunately, a lot of retail traders, they don't take this advice seriously until they learn it the hard way. Then a second type of trader, which is very common in the retail trading world, is day traders. So if you're a day trader, your holding period is between 1 hour to 1 day. Basically, you trade the M30 time frame, H1 time frame, and also H4 time frame. Basically, you won't have overnight open positions. Your trade wouldn't see the sun. For the next day, it wouldn't see the sun. You would require less screen time as compared to scalpers, which is a good thing, and hence you experience less stress. So if you're somebody who cannot sleep with an open trade, then you can consider becoming a day trader. Then the next type of trader is swing trader. You let your money roll overnight. Let it dry overnight. So basically your holding period would be several days to weeks. And you would trade your H1, H4, daily and weekly time frame. And this is suitable for busy working professionals. If you're working 9 to 5, you're studying part-time while working full-time with 3 cats to feed, go for swing trading. So day traders, they focus a lot on technical analysis, but swing traders, they are technically and fundamentally focused. Of course, there are day traders who look at news as well, but their main focus is technical analysis. And the next one is position trader. Their holding periods would be from weeks to months to years. Basically trend following, okay? Some people call them a trend follower. And the time frame would be daily, weekly, monthly. So these traders, they focus more on fundamental analysis. And the good thing about being a position trader is that you get good risk to reward ratio, but the downside is that your win rate would be lower. So if you want to have a good risk to reward ratio, you need to compromise on one thing, which is your win rate. And it requires the least amount of screen time after you have opened the trade. But of course, before, when you enter the trade, you gotta put in the screen time to research, do your fundamental analysis, and also technical analysis for you to be able to enter the trade. But this is the good thing about being a position trader. In fact, a lot of professional traders, they focus on this one and also swing trading. Whereas the retail traders, they are more on the day traders scalping side. Why? Because fundamental analysis, it is harder to learn, and most retail traders just don't have the patience. Ain't nobody has got time for that. Anyway, types of entry orders. First one is your market order, and on your platform it is written as market execution, MT4. Basically, when you are putting in a market order, you are executing an order right now. Okay, right now. And there's a second type of order, it's called pending order. If you look at MT4, it is written as pending order, but it is also called a limit order. Okay. When it comes to a limit order, when you see this word limit, you are executing an order, buy or sell order, at a more favorable price. Stop order is also under pending order, and you are buying and selling at a less favorable price. So if you go to your platform and you go to here, type, you will have 2 choices. So how do you go to this order window? You just click on this, okay, new order. Then you would have this window pop up. Then you see 2 types of orders, pending order and also market execution. Right? Market execution is just very straightforward. Once you click on this, you just click sell or buy. But when you click on pending order, you will come to this window over here. Then you need to pick the type of order: buy limit, sell limit, buy stop, or sell stop. Like I said, when it comes to limit orders, you're buying at a more favorable price. Stop orders, you're buying at a less favorable price. Okay? And the good thing about these orders is that you can delete it before it is executed. But if you enter a market order in your dreams, you cannot delete it without experiencing a loss or a profit. Okay, so what is a buy limit order? So let's say now the price is over here and you feel that it's too high. So you set a buy limit at the bottom so that you can buy at this level. When the price comes down to this level, your trade would get executed, and then when the price goes up, then you make money. So when you set a sell limit, you feel that the current price is too low right now, so you want to buy at a higher price. So you set a sell limit on top. Hopefully the price is going to go up to execute your order, and then hopefully later on the price is going to go down so they can make money. So when you set a buy stop, instead of buying at a lower price, you want the price to go higher. Let's say the current price is over here. You feel that, okay, the price is too low, I want to buy at a higher price later on. Let's say you want to wait for a confirmation candle before you buy, so you set a buy stop on top, okay? And hopefully when the trade is executed, the price is going to continue to go up so that you can make money. And when you set a sell stop, you want to buy at a lower price, so you set a sell stop below, and hopefully the price is going to come down, execute your trade. Later on, the price hopefully is going to continue to go down so that you make money. So this for entry orders. Then for exit orders, just now I mentioned already, you have your stop loss and also your take profits. A lot of retail traders, they click buy and sell, then they start to panic. Okay, where should I set my stop loss? Where should I set my TP? Please don't do that, because after you click these two buttons, these two freaking buttons, by the time you decide where your stop loss is going to be, you're going to set it based on emotions. Understand what I'm saying? If you don't believe, just try it. Just try it. And types of analysis, there are 3 ways that you can analyze the forex markets: fundamental analysis, technical, and also sentiment. To increase your probability, you need to learn all these 3. I don't know about scalpers, but if you're a day trader, you cannot completely ignore fundamental analysis. If you're a long-term trader, you also cannot completely ignore technicals. Understand what I'm saying? So I want to talk a little bit more about these 2. Sentiment, I wouldn't cover it in this lesson, maybe next time, because I can talk for a whole entire video on that. So what is fundamental analysis? Basically, you're looking at economic indicators that moves the markets, the currencies. So what are the market moving economic indicators? Example, consumer confidence, PPI, CPI, retail sales. Now some of them are lagging, some of them are leading. Trade balance, employment data, GDP, and also there are a lot more indicators, which maybe I'll cover more on that in the next few videos. So to differentiate yourself from other retail traders and trade like the pros, you need to learn which are the leading indicators, which are the lagging indicators. Of course, you don't completely ignore the lagging economic indicators, because the Fed, they pay attention to the lagging economic indicators and they make decisions based on that. Okay? So you need to look at both, just that you cannot look at what most retail traders are looking at and then trade based on that. Because what a lot of retail traders are doing is that they are trading based on lagging economic indicators, which doesn't make sense. So some central banks that you need to take note of is US Federal Reserve, the Fed, Bank of England, Bank of Japan, European Central Bank, ECB, SNB, Swiss National Bank. These are the central banks you need to take note of, especially if you trade the currency pairs that they are paying attention to. So some central bank terms you need to know. First thing first is hawkish. When central banks are hawkish, this means that they are positive about the future economic outlook. Okay, so when they are positive about it, they are looking to increase interest rates. And this means that they need to tighten the monetary policies. And some people call this the contractionary monetary policy. So why do they want to do this? Is because they want to keep inflation rates low. They want to reduce inflation. And hence, overall, this would lead to the currency of that country to appreciate. When central banks are dovish, is the opposite. This means that they are negative about the future outlook of the economy. Potentially, they would want to decrease interest rate, they want to cut rates, they want to stimulate the economy, they want inflation rates to increase, and hence overall this would cause the currency to depreciate. And the next thing is intervention. So when central banks intervene, it's going to cause a massive move in the markets. So take note of when the interventions are, and if you are a day trader, try to avoid trading during these times. So like I said just now, contractionary monetary policy and also loosening monetary policy. So this is when central bank is on the hawkish side. Loosening monetary policy, or some people call it the expansionary monetary policy. This is when central banks is on the dovish side. So when you see inflation going beyond normal levels, and when the economy is going too fast, the central bank is going to step in and increase interest rates, and hence the currency is going to increase. Alright, so when it comes to inflation rate, you need to understand what range is a normal range, what range is way beyond acceptable levels. So this is a little bit on the fundamental side, but of course we can talk more on this next time. And when it comes to technical side, you also need to learn how to read the charts. So how do you spot an uptrend? To put it simply, you can just look at the price action. When the price is making higher highs, then this is an uptrend. Okay, common sense, higher lows. Another way you can determine that is draw a trend line. When the trend line is sloping up, then this is an uptrend. And also when the moving average is sloping up, this also indicates an uptrend, especially when the price is above your long-term moving average. Same thing for downtrend, lower lows and lower highs. When the price is below moving average and moving average is sloping down, it's a downtrend. And there are three main stages of a trend: initial stage, mid-trend, and also final stage. So you need to learn how to spot where's the initial stage, mid-trend, and also final stage. I've already done a video on this, you can go and check it out if you want to. Next thing is type of brokers. So there are a few main types of brokers, market makers. Some people call them the dealing desk. And then you also have ECN, electronic communication networks. And also you have STP, straight through processing. Again, I've done a video on this, you can go and check it out. I go into detail all these different types of brokers and which one you should choose. But basically, if you want to open a brokerage account, make sure you follow these few steps. Think first, pick an account type and then the leverage you want to trade with. Because some brokers, they offer different types of accounts. And then you need to submit your personal information and documents to the broker. After that, you need to wait for verification. And then after that, you need to fund your account. Then after that, you will receive all the details of your account. Then you can start trading from there. Once you have received the details of your account, then you can download MT4 and then start trading. But before you even do that, make sure you pick the right broker. Because a lot of retail traders, the way they pick a broker is, it is so cheap, their spread is so low. That's why I pick. If you pick a wife and husband today, would you be like, based on one criteria only? So the mistake that a lot of beginner traders make when they pick brokers is, oh, I pick you based on high leverage, lower spread. Okay, you don't need to pay much to get into it. Lowest capital requirement. They also pick it based on lowest capital requirement. And they pick it based on how famous it is. Like, are you a fame digger or something? The way beginner traders pick brokers, they are acting like fame diggers plus gold diggers. You want big money with small amount of commitment. This is what most retail traders want. This is what most beginner traders want. Of course, all these things are important. Yes, I understand where they are coming from, high leverage, because you want to make a lot of money. You want to commit as little as possible. And famous broker, if everybody likes you, then must be good, right? If I'm to ask you, does McDonald's sell the best tasting burger in the world? No. Then why are they most famous for selling burgers? It's because they are good at marketing. So famous doesn't always mean good. So the thing is, you gotta look at different criteria. You gotta test your broker. First thing first, you need to look at this thing called trade execution speed. How fast is your trade executed? Like earlier in this lecture, I did mention if it takes more than 3 seconds, like a freaking PlayStation 1, then you gotta, in fact, PlayStation 1, it loads super long. My point is, if it loads more than 3 seconds, please leave. Withdrawal speed. Now, a lot of brokers, they be like, give me money, okay? Then they process your deposit really fast because you're giving them money. But if you want to withdraw money, oh my god, wait. We got a little bit of technical issues. I'm so sorry, today is not a working day for us, even though it's a Monday, but in our country, we operate differently. I'm so sorry, my internet connection is not really good, so you gotta wait for a couple more days. Then they make you wait. If your broker really cares about you, he's gonna give you your money back really fast. And also look at the ability to respond to customer inquiry. By customer inquiry, I don't mean like a virtual bot. Hi, I'm Mary. How can I assist you today? Then you'll be like, how come I cannot get my capital back after 3 days? I'm so sorry. We don't understand the question that you've just typed in. Can you please retype the question? They need to have a person to respond to you, to take care of you. Like you matter to them. Customer service is very important, okay? And the next thing is you need to compare prices with various brokers. So it's very good to have 2 to 3 brokers so that you don't put all your capital into one broker because that's risky. And also second thing is so you can compare prices. Like for example, if you get stopped out in one broker but you don't get stopped out in another broker, then there's something wrong. Aside from the fact that, okay, maybe that's because of the spread, but if the price deviates too far from each other, then one of them is doing something fishy. Next thing is test their demo accounts and software. Basically, you gotta test and test to familiarize yourself with their platform and also to check how fast their execution speed is. Basically, try out everything, okay? So the things before you go and trade live, you gotta do a couple of things. First thing first, learn all the basics and fundamentals. Develop a strategy that suits your trading personality. Basically, have a proper trading plan. And then practice in a demo account. After that, start a small live account. And along the way, make sure you journal and then learn from your mistakes. Even when you're demo trading, you should start a trade journal. Don't wait until you go live, then you start a trade journal. It's too late. It's too late in the game. So if you're a complete beginner and you want to learn how to pick the right broker, and if you want to learn technical analysis in a bit more detail, you can check out these 2 videos. And also I'll be launching some free lectures in the next few months, so if you subscribe, then you won't miss out on these things. I'll talk to you in the next lecture video. Bye.